My name is Andrew Benetti, and I'm one of the financial planners here at CCR Wealth Management. The goal of today's video is to touch on a couple of the next generation financial wellness topics we see clients having more and more questions about. At CCR Wealth Management, the foundation of all of our client relationships is rooted in the financial plan. As we tell most clients, if we don't know what your financial plan is, we have a difficult time making projections or recommendations on all of your outside assets. The textbook definition of financial planning is the process of formulating, implementing, and monitoring financial decisions into an integrated plan that serves as a guide for an individual or family to achieve their financial goals. Financial planning can mean different things to different people, and depending on what stage in your life you're at, it can involve things like retirement planning, after-tax savings, college savings, budgeting and expenses, or even starting a business. Those are certainly important elements to consider, but what we're seeing more and more, especially with some of our younger clients, is that there's a next generation of financial wellness topics that they need guidance on. There was a study done in 2017 by the Federal Reserve Board that found that approximately 40% of Americans cannot withstand an unexpected $400 expense. The good news is that number is decreasing from a study that was done in prior years. The bad news is that us as a society do not save enough in our emergency accounts. What that can lead to is a scramble for finding some sort of financing at the very last minute, or even worse, putting money onto a credit card and incurring costly credit card debt. One of the first items we discuss with clients is emergency savings. The generally accepted principles are that you have 3 to 6 months of non-discretionary expenses saved in a bank account accessible to you at any point. A monthly non-discretionary expense would be something like a mortgage payment, an auto loan, food, or even an insurance payment. Basically something that has to get paid that month. The important thing to remember here is that emergency fund savings are intended for just that, an emergency. Another question we often get is, where should I hold these emergency funds? We see an increased number of clients using high-yield online savings accounts through things like Ally Bank, Capital One, or Goldman Sachs. The idea there is that the money is accessible to you at any point, however, you actually get a decent yield out of the account, so it's not like your money is sitting there not earning anything for you. Lastly, and maybe most importantly, the 3 to 6 months is merely a guideline. Depending on what stage in your life you're in or what major purchases you have coming up, your actual cash holdings in your portfolio may be greater than the 3 to 6 months. Another important element in general financial wellness is debt management. Debt isn't necessarily a bad thing, but we want to make sure that given current interest rates and the type of debt accounts you have, you're keeping control of your monthly payments and also paying things in advance if you can. There are two main methods used to pay off debt. One is the debt snowball approach, the other is the debt avalanche approach. The debt snowball approach has you making minimum monthly payments on all of your debt accounts, at which point you'll take any extra dollars intended to cover debts and start paying off the largest account balance first. The idea there is that as you start to pay off these accounts, your number of outstanding debt accounts gets smaller and smaller. Similar to a snowball rolling down a hill, you start to gain momentum as you close out these accounts. The other way is the debt avalanche system. The debt avalanche system is based on prioritizing your debts by highest interest rate. The idea there is that you make minimum monthly payments on all your accounts again. This time, any extra money that is intended to cover debt goes towards the highest interest rate account first. Both of these systems work and both have their merits. The debt avalanche system is mathematically better as it saves you more money over time, but the ultimate idea is that you want to get your debt picture in order. You want to take a look at the outstanding balances and you want to review your interest rates. We're in an interesting interest rate environment. It's at a historical low point, so now may be a time that you consider refinancing, consolidation, or even a 0% balance transfer. One of the biggest financial events in your life is putting down roots. Having children or buying a home are expensive endeavors. We want to provide you with tips to make those as easy as possible. When buying a home, we recommend you do a thorough analysis to find out how much you can afford. Once you have that number in mind, you can start to set parameters around what area you may want to live in or what type of home you want to buy. Banks usually have two ratios they use to benchmark affordability of homes. The first one is monthly home expenses divided by your monthly gross income should not exceed 28%. The second one is that your monthly home expenses plus your monthly debt obligations divided by your monthly income should not exceed 36%. Those are pretty good guidelines to use when deciding on affordability. Lastly, when it comes to purchasing a home, we always recommend clients put down 20% of the purchase price. By putting this large sum of money down, you're able to get the most competitive mortgage rate and also avoid paying costly private mortgage insurance. There's no doubt that raising a child is expensive. A 2015 study listed the cost of raising a child from birth to age 17 at approximately $235,000. I'd add in that depending on the part of the country you live in, that number could actually be much higher. Before having a child, it's really important to have a good handle on your monthly cash flows. How much comes in, how much goes out, and how much can you afford to bring another person into the family. A note on college savings. If you and your family do choose to foot the bill for your child to go through college, it's going to be expensive. My colleague Michael is going to be doing a similar webinar on that, but I'll leave you with one thought. Start now. Time is your biggest ally. As you begin to get things going, you'll see that you're putting a lot of time and effort into planning your financial future. One of the things that we often discuss with clients is not 100% financial, and that's estate planning. Estate planning is the process of ensuring that your wants and desires are carried out in the most efficient and effective manner. The most efficient manner is a reference to the financial side, so whether that means being tax efficient or ensuring that your financial accounts are passed on appropriately. The most effective manner is a reference to the qualitative side, making sure that your wishes are carried out appropriately on all non-financial assets. Planning for your estate can involve both personal and professional items. For example, something like an IRA or ownership in a business interest. Generally, we encourage our clients to sit down with an estate planning attorney to go through all of the documents they need. There are a few that are the most basic that we encourage everyone to get. The first being a healthcare proxy. A healthcare proxy gives somebody else the ability to speak for you if you are unable to speak for yourself when it comes to medical issues. The next one being a power of attorney. The power of attorney is a very important document that gives somebody the ability to act as you for legal and financial consideration if you are unable to do so for yourself. The next one being a living will. The living will expresses your interest in your end-of-life situation. The final one being your last will and testament. That's where you handle passing on a lot of your assets, both financial and non-financial, to your heirs. Estate planning is not limited to the above documents only and may involve the use of a trust if the circumstances deem it necessary. We encourage everyone to sit with an estate planning attorney to go over what is necessary for their specific situation. We work with many in the area and are glad to make a recommendation for that. If you have any questions or concerns about these financial wellness topics or any others, please feel free to reach out to the team here at CCR Wealth Management. We'd be glad to help you as best we can.